Hello, 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 and welcome back to today's podcast. Thank you very much for being here. Today, we have an amazing guest, but before we get started, I want you to know that we have an amazing deal on the book bundle. And here they are. Okay, Becoming Your Own Banker, Life Without the Bank, and Farming Without the Bank. You not only get $10 off right now for Christmas, but you are also getting both audiobooks for free. So if you go to withoutthebank.com or farmingwithoutthebank.com, either one, you are going to be able to get that 3-book bundle with free audiobooks. Then you can send all the audiobooks to whoever likes to listen on audio. But it is the giving season. So give some books so people can read. There you go. Grab your books. All right. Today we have Clay Summers with us, and Clay is an employee of One America, and that is the company that I write the majority of my business with because they're amazing. And you guys hear me talk all the time about what the vital signs and the company performance and those sort of things, and how universal works or index works and all that good stuff. And so today I wanted to bring Clay on so that you guys can hear it from somebody within the company, how that affects policies, how that affects the insurance company, the fact that they have risk and all those things to look at. So again, Clay Summers from One America. We are going to have a great conversation. Okay, let's welcome Clay. Thank you very much. He is the Field Vice President of Life Sales with One America, and we are going to find out all good things today. So thank you very much, Clay, for being here.
Thank you, Mary Jo. It's a pleasure to be with you.
Now, you guys, everybody listening, this is a big deal to have somebody from a life insurance company willing to put their face out on the internet and answering some questions. I am telling you, I listen to a lot of podcasts, and a lot of us as agents will relay what home office tells us, but we rarely get to talk to somebody from home office. So we're going to hear it from the horse's mouth today. Well, he's or one of the horse's
Thank
mouths.
you, Mary Jo.
You're welcome, Clay. You're welcome. All right. So Clay, first remind me, how long have you been in the industry?
Oh my. Well, this is my 40th year in the industry.
Okay.
The first portion of that, I was actually a career agent for One America. At that time, would have been known more as American United Life. And then I've been inside the home office the rest of that time. Done a lot of different things for the company.
And I think that is important because you're not some new guy just coming in saying, oh, this is what's happened. Clay knows history, and this is also why it is so important. He really is my go-to guy at One America when I have questions, because Clay's been there forever. And he's been in the industry forever. And so it is hard to find Clay Summers out in the world because there's just a lot of new people coming into the industry, and they maybe don't have the knowledge and the history to back that up. So today, Clay, I want to talk about something that you and I have talked about several times in the past. And let's start with 1090s, 9010s, whatever they're called. So there are agents out there, and there's a lot of noise in the industry right now about a 1090 policy where the 90% of our premium is going to paid up additions. And there's a lot of people saying that's the only way to do it. And although those policies are great, One America does not allow those, and a lot of companies actually do not allow those. I don't write with a company that allows them. And so there's a reason why. And I think that people need to hear the reason why, and that there's some risk for the insurance company. So can you just share with us why maybe a more conservative company is not jumping on that bandwagon and saying, oh, yay, this is great. Let's sell some more life insurance.
Well, thanks, Mary Jo. And I think what you're referring to when you say 1090, I think what you mean is like a policy that would be configured with 10% base coverage based on the premium, and then 90% into some type of a paid-up addition rider, where you're purchasing paid-up additions with out-of-pocket premiums. And at our company, we don't allow such a deep blend or mix of that. I think the maximum on an ongoing basis for us is like 75% into the PUA rider and 25% into the base. So to go much deeper than where we are, it becomes a little bit of a strain on a company. And there's a couple of reasons for that. First of all, you have to remember that paid-up addition rider premiums generally are optional premiums. You don't have to pay them. You could choose in any year to pay zero or a smaller amount or perhaps a larger amount. I'm sure every company has their minimums and maximums. So since that's optional, companies build all of the expense charges, the loads, to put a policy in force into the base coverage only. Because down the road, you want to be able to have, if you think about it, companies have to, there's really several things that they have to do with those policies. When we collect a premium, we have to cover the expenses of being in business. We have to also pay for mortality, right? These are life insurance policies. People pass away, we have to pay the death benefit. So those are two big things that are loaded into a policy that your premiums have to pay for. And so if you could choose to pay, only 10% of the premium you decided to start with, then we might not get all the expenses we need to keep our expenses, to cover the expenses we have. So companies generally load most of their policy expenses into base coverage. And if they don't have enough to cover that, then what happens down the road is it affects in-force policies, right? Especially with a company that is a mutual organization that would pay dividends. Dividends are paid when we've essentially collected more premium that we need to cover all of our expenses and pay all of our, the claims and that type of thing. So we would return any excess to the policyholder. So anytime you would have somebody who could choose, like on a 90% basis, to not have to pay expense loads, then that would hurt in-force policies down the road. So allowing more than a 25% base mix really becomes very difficult to price a product. You would probably have to price your product completely differently if you were going to allow that. And then that might take away some of the appeal that people thought about in the 1090 world in the first place.
Mm-hmm.
The only other thing
what is that? Now you said that could hurt policyholders down the road. How would that hurt them, the in-force policyholders?
So there's a couple of ways. One way is that if we're not collecting enough expenses than we had priced for from our policies, then that would mean that it would very likely affect the dividends that we would be able to pay. And dividends are only paid on in-force policies, right? So I always say that policyholders are going to be in-force policyholders a lot longer than they're going to be new policyholders, right? And so we always think about our in-force policyholders, because obviously they've been with us a long time, and you wouldn't want to buy a life policy if you didn't think that a company was going to treat its in-force policyholders well. Mm-hmm. In any event, so obviously if we can't cover our expenses, that's the way we thought, then dividends might not be what we thought. Mm-hmm. The other thing to think about is think a little bit about the being fair to in-force policyholders as far as the return on your investment. And I shouldn't say the word investment, because let me be very clear, whole life insurance is not an investment. But all of the money that backs the cash value of a whole life policy. In other words, when you look at your whole life policy and you see that schedule of cash value that is guaranteed to grow, that's backed by an insurance company, what we call our general account. And that general account generally made up with fixed investments, mostly bonds, mortgages, fixed return instruments. And so we buy those every year. We bought them for years and years. So if you bought your policy years and years ago, we've been building up our general account with those assets that we've invested. And as you can know, with bonds and other type of instruments, they're generally longer term things. You could buy a 30-year bond, you could buy 20-year bond, 10-year bond. In any event, lately we've seen interest rates kind of go down, although, I mean, very lately we've seen them come back up. But I'd say over the last decade at least, in fact, much longer, we've seen interest rates kind of trend down. And so, you know, that's for people who've been with us a long time. We have a lot of investments that we've purchased years ago that are helping support their policy. So when we bring new policyholders in a environment when interest rates are down, then we're buying a lot of money. We're buying a lot of investments that are lower than our current investments. So that tends to bring down that general account return. And so if you're paid up additions generally, because they have very high early cash value generally, then they jump into and capture a general account's return quickly. And so that's fair to a certain extent, but it wouldn't be fair if we allowed a lot of that to happen, because that would hurt the in-force returns. And again, I'm probably trying to oversimplify this in a very short period of time, but that if we were to allow a lot of PUA rider premium to come in on every policy we sold, that would and in a down interest rate environment, that would cause our general account return to lower faster than maybe it would normally lower, and that would eventually hurt all in-force policy.
Which in turn affects dividends, which in turn, like, because we have to pull money from somewhere to cover expenses that were not covered because we don't have the money in the investment accounts to make it. And so I feel like people that are writing these policies aren't seeing that. Myself as a agent, but yet a consumer, I want to make sure that my policy is there till I'm 121. I want to make sure that my client's policy is going to get paid if they turn 121 and they're zero today. They're newborns, but we have put money into something, and we want to make sure that our company is vital and is going to sustain all the ups and the downs. And if we are not pricing products correctly, or as we've talked about before, that paid up addition money can be pulled out. Well, that also can affect everything. And so there's a lot of stuff with the PUA that can affect the company. And Nelson said, right, in his book, people, in his book, I don't remember what page it is. Let me look. It's the twin sister example. So he talks about CDs versus life insurance, page 45 of Nelson's book. He compares a CD to a whole life policy. The only difference as of to why the whole life policy was better than a CD is because of dividends. This is super important. If a company can't pay the dividends, then what is the difference if it's mutual or stock? Why don't we just go buy ourselves a CD if we're going to do banking with it? And so the long-term effect of it, the long-term effect of what I'm hearing you say, the general account, is a big deal.
It is.
Okay.
No question.
So can you explain the paid up additions? That can be taken out, correct? Withdrawn.
Well, there's a lot there.
Nobody should do this, by the way. Do not. This is an option that nobody should use, but it is a risk that the company needs to look at.
So a PUA, paid up addition, really stands for paid up additional amount of whole life insurance. And so the difference between a PUA, there was a lot of differences, but one big difference between a PUA and like your base, forever pay whole life policy would be that it's a single pay, right? It's paid up. It's a single pay. You take whatever, either through a rider without a pocket premium, or through perhaps a dividend option where your dividends are purchasing PUAs. the whole idea is whatever that dollar amount is of that, either the premium like I described or the dividend, is going to it's going to serve as a single premium to purchase the paid up edition, and it purchases a paid up amount of whole life insurance coverage, right? And so and then what happens is, because of many of the things I already talked about earlier, it usually has a much higher cash value than like base coverage would have from day one, right? Early cash value, just because of a lot of factors. But then once that cash value is established, it's going to grow, guaranteed cash value wise, just like any other whole life coverage would grow. It may be, the slope may be a little different or whatever based on the company, but the whole idea is then that cash, it would have an internal cash value that eventually grows to whatever the original face amount of coverage that single premium bought at policy maturity. So I'll give you an example in numbers, and this is just purely hypothetical. But if you had $1,000 dividend and it purchased a PUA, let's say, again, this would be based on age, gender, risk class, but let's say it purchases $3,000 worth of paid up edition life coverage. So we might start out with them with a cash value as high as, I don't know, maybe even $900 out of the $1,000 of the dividend that was purchasing the coverage. But then the point is that 900, let's say it started at 900, between now, whatever your current age is, and policy maturity, that 900 would eventually grow to exactly $3,000. And so that's how a paid up whole life edition works. Now, the nice thing is paid up edition of whole life is whole life, and base coverage is whole life. Guess what? They're both eligible to pay dividends. So, you would get dividends might spin off of base coverage. Dividends then might also spin off of PUAs. Keep in mind, dividends are never guaranteed, and
Right.
But they may be paid, and if they are paid, they would then purchase whatever your dividend option is telling them to purchase, which is, if in my example, we just start to purchase more and more PUAs down the road. So I don't know, and that's probably, hopefully that gives you a little bit of a feel for how PUAs work. And
Yeah, but what happens if they withdraw them? Can they withdraw that
Thank you.
premium? That's okay.
that's
That
all
is a
right.
good explanation we needed. So
So PUAs, you can access PUAs from a whole life policy generally in one of two ways. One, of course, is to borrow against them. And then the other way is paid up edition cash value uniquely can be partially surrendered. So if you think about base coverage, whole life cash value, the only way to access that would be to borrow against it. The only other way to get that would be to completely surrender your policy, and we would then, the company would pay you the cash value, and your policy would be gone. But PUAs, since they're on top of your base coverage, those can be what we call partially surrendered. So like if you had a total of, generally all PUAs are usually lumped into one big, I'm going to use the word bucket for lack of a better way to put it. So even though you've bought a lot of PUAs over the lifetime of the contract, perhaps, generally companies just put them all in one bucket and would tell you your total PUAs are X, either total face or total cash value. So then if you wanted, let's say you had a total paid up edition cash value of $20,000, you could partially surrender paid up editions to take 5,000 of that 20,000 out. The reason we call it a partial surrender instead of a withdrawal is that the death benefit that is supported by the cash value that you would partially surrender is also partially surrendered. So you're surrendering, a portion of your coverage to take that cash value out. The way it looks and feels a lot like a withdrawal, and so that's why people would say you can withdraw PUA cash value, because what you're really doing is partially surrendering it, but it has the look and feel
So for those of you that are listening that don't quite understand that, if I am going to surrender $10,000 of PUAs, my ultimate death benefit is going to go down. We are not borrowing it. You cannot put it back in. You are literally surrendering it, and it is, you can't ever put it back. So does that hurt the company's financials when that's done, Clay?
Well, when we price a product, we, you know, we have an assumption for a lot of things that would happen over the long haul. And we assume a certain level of PUA surrenders when we price the product. So we're prepared for that for the most part. I would say that, normal paid up edition rider surrenders is probably very much anticipated and priced for in the product.
So is it safe to say, in Mary Jo terminology, because I'm special, is it is it safe to say that if we're going to surrender PUA, then that money is coming out of the general account, which cannot be invested, which is also then going to hurt possible dividends, possible growth of the general account?
Well, there'd be a lot of factors to consider.
Okay.
For instance, if it depends upon where interest rates are. Are they going up? Are they coming down?
True.
Investments that back that, were they higher or lower when they purchased? There's just so many factors there. The one thing that's important is that the company has enough reserves to be able to handle surrenders. And, you would want to make sure that you look for a conservative company that is, of course, following all the reserve rules and ensuring that they're able to handle those surrenders. I would, however, throw out to clients, of course, if you need money, you need money. But, it may not be in your best interest to surrender a paid up edition. It's something that you purchased a long time ago that's now, in its X number of years down the road. You purchased that back when you were younger. And, when you're younger, mortality charges are less. It's to surrender a paid up edition. I would take a long, hard look at what the future projection of that value is versus what you think you need that PUA cash value to do somewhere else.
Well, I think there's enough other ways to access money in a policy that we don't have to do that. And I think that some of that is just bad old advice. I've had people tell me that, the accountant said grandpa or dad should cancel that policy because he's 90 years old and he doesn't need it. And he's going to die before he's ever going to need to use any of that cash value. And so they cancel the policy, and then he pays gains on any interest earned, and the family's out of any death benefit to bury dad. Like, some of that is just really bad advice from people that don't understand life insurance. And so I always go to your life insurance agent, and hopefully they're knowledgeable enough to know. But I think that what you said earlier is key, that there's just a lot of factors and a lot of things, and people are getting there's just so much noise because there's so many agents saying this is how it should be done. And if we look at Nelson's book, there were a million ways that he structured policies. He didn't just do a 50-50 split or a 10, he never did a 1090, but there are many ways. There are times where I've had to put 100% of my premium to base, meaning buying traditional whole life, straight up traditional old fashioned whole life is what I call it, because that is going to be the best option for that situation. And so we are very quick to say this is how it should be done because you have more access to cash, but we are not looking at how that is going to affect the company. And I just assumed everybody knew that because I just kind of assumed everybody has a Clay in their life. And so when you and I got off our phone call previously talking about this, I had talked to another agent about it, and they go, "Oh, I didn't even think about that." And this is a colleague that is amazing, and he is very, very good at what he does, and he's conservative and he's very smart, but he did not understand the effects on the company because nobody's talking about it. All we're talking about is how can we sell insurance and how can we provide cash. So it is definitely important to understand that. Now, you made a comment that I don't know if you can comment on this or not, but you said there's reserve there's reserve rules. I did not know that, Clay. So what are these reserve rules?
You know what? I'm not an expert in reserves. And so I probably wouldn't feel very comfortable answering too much about that. But absolutely, insurance companies are subject to reserve requirements to ensure that we're able to meet the obligations that we have financially. And
Well, I
insurance
know other
companies,
people that I could be asking that to. So other people in the company that deal with it, not you.
thank you.
You're welcome. I will ask the appropriate individual. Okay, so here is something else that I think we're pretty good, and we've covered that as best that we can. I mean, I think there's other things that come into play with how policy structure is, but from a company standpoint, that is important. Now, the other thing that you are so good about teaching agents is the difference between a whole life, a variable life, a variable universal, a universal, and an indexed. And oh my gosh, I just heard yesterday, a client said, oh, on Instagram, I heard that I should be putting money into an indexed UL as a savings account rather than a whole life, and use the whole life for banking. And I said that the indexed UL has a 0 guarantee floor. But if you get an illustration, which I have plenty of them, in parentheses, it will say negative whatever because of fees and charges. So yes, you're not going to lose, you're not going to lose anything based on the index, but we are going to have fees and charges and still go negative. And his response was, well, they're not saying that. No, of course they're not. And so I preach it all the time. But if you could just touch on the differences between those, and the biggest being how whole life is priced, because so many people, Clay, will say, well, what are the fees? And they don't understand there's not outside policy fees. So,
Well, I think what you're referring to there is whole life policy is, well, a universal life type policy is, for lack of a better word, very transparent. You can almost all UL policies, you can kind of see through the contract and see virtually where every dime of your premium is going, right? It'll actually illustrate out the, you can pick apart, even on a monthly basis, you can pick apart how much is going towards mortality charges, COIs, costs of insurance, and how much of your money is going towards expenses. And generally they'll have multiple expenses, so that you'll see it's going for a premium expense or a monthly expense or a death benefit expense or something like that. And then you can pick out, what type of return that you've earned for that month. And so you can actually really determine, why and how your premium went in and resulted in this type of a cash value. It's very transparent. Whole life is not. Whole life is what I like to refer to as a bundled contract. Whole life is, there's not much transparency there, because whole life makes 3 guarantees. We guarantee generally a level premium. We guarantee a cash value that's guaranteed to increase every year. And then the third thing is they guarantee a level, generally a level death benefit. That's how whole life policies generally work. And so it's kind of a set it and forget it product. If you're pleased with the premium that's been prescribed for your age, gender, risk class, number of thousands, that sort of thing, then that's the deal. And if you're pleased with the cash value growth, then you should be pleased. You're not going to be able to see behind the scenes how we got from premiums to cash value. However, if you have a whole life policy with a mutual organization that has the ability to pay dividends, think about what's happening behind the scenes. When we price a product, we use professionals called actuaries. And you should Google an actuary to see what it takes to become an actuary. These are very intelligent people with mathematics, and they project not only mortality, they project expenses, they project what's going to happen in the economy. They're professionals there, and every company has teams of actuaries who develop pricing. So what they're asked to do is they'll say, okay, so for a particular age or every age, for each $1,000 worth of whole life coverage, you need to come up with the premium that we need to charge that we can guarantee, no matter what happens down the road forever, that we'll be able to keep that policy in force all the way to policy maturity, which today generally like age 121, which is in a lifetime, that's forever, right? What we call whole life. In any event, the whole idea there is that the actuary then has to price that so that if anything happens, we have to stick with that premium. It has to support that coverage. And you'd think, well, of course they're going to be conservative with that, right? I mean, think about yourself. If I asked you to do that, Mary Jo, if I said, if I had a contract with you and I asked you to figure out the premium and you had to be good forever, you'd be conservative. You'd err on the conservative side, but everyone would. And so, of course, the companies generally do that. But here's the great news. If you're with a mutual organization, every year we check, right? We check to see, okay, this year, how did we do? We had projected our mortality to be here. We had projected our expenses to be here. We had projected our return on investments that we invest your money in to be here. And if we've done a good job at that, then we're going to have essentially, you call it like a profit. You'd have more money than we had priced for. Mm-hmm. So when you have extra money, generally in any company, you would return that to the owners of the company as a return on their investment, if you will, or return on their business. And so we do the same. We would return our profits, if you will, to the owners of our company. And the owners of a mutual organization are its policyholders. So we return that to our policyholders in the form of a dividend. So even though we're conservative on the front end with a premium, who cares? Because, well, I shouldn't say who cares. The point is, down the road, if you're going to get the dividend back, and again, dividends are not guaranteed, but if you have the promise, then if we're doing well, then you'll receive that profit back to the policyholders. Then I think that's a great situation to be in purchasing a financial instrument like whole life. Does that make sense?
Yep. So I think people need to understand this again, Mary Jo terminology. One America or any mutual company is going to say, I am going to price and maybe overprice, or I'm going to be conservative and say, okay, we're going to have to pay this many claims. So death benefit price is going to be, the cost of insurance is going to be XYZ. But we didn't need all of that cost. So we're going to return some of that back to the policyholder because we did not need that. So how is that whole life, which is a bundle, different and priced differently than a universal, a variable, and an indexed?
Well, okay, so you mentioned variable universal life. I suppose I heard you say universal life, which would be like a traditional fixed universal life. And then I think I heard you mention indexed universal life, right? And so all three of those products are universal life. They all have the words universal life in their name. And so sometimes what I like to do is kind of separate the two when I look at a particular product, separate the return feature from the universal life chassis. Okay. So you mentioned traditional UL, VUL, IUL. They all have UL in the title. So they're all a UL policy. And so I do think if I were buying UL, I would seek to really understand the universal life chassis and how it works. Then you might want to also focus on how the company, the return feature of that product. When you mentioned variable universal life, the return that comes from that is quite different than the way a traditional or an index universal life provides return into the contract.
So can we start with I don't mean to interrupt you, but can we start with the chassis and how the universal chassis works compared to maybe a whole life?
Sure. And, these are generals. The generalizations is how I would describe what I would mention. There's all types of products and they all differ. But generally with a universal life policy, once again, a very transparent contract. You can see the charges, you can see the premiums going in, you can see the return that's coming back. The one thing about a universal life policy, it's very flexible. In fact, it allows the policyholder to make to make changes in the contract, way more so than like a whole life type product. So, for instance, in any one particular month, the return could vary in the contract. The internal charges could vary for the mortality. The expense charges could vary. The client could reduce their premium. They could change their premium at any time, generally. They could make a withdrawal against their cash value. In some policies, they allow you to even increase the death benefit. But a lot of things can be changed.
So So in a whole life that's set, we have determined that until maturity of the contract, these are going to be our cost of insurance charges. Why in a universal is that not set and can be changed? Is it because they underprice it? Is it because people are just trying to sell insurance? Why is it not a set price like whole life?
Well, it's probably more similar than you think. But, generally, the UL policies I've seen have like a current level of mortality charges and expense loads. And then they have generally some type of a guaranteed maximum. And then the company can then decide if they want to increase or decrease. They can make those changes based on their own experience down the road.
And they can charge. So here's the one piece that whole life does not have certain expenses and fees that universal has. So universal life, I just saw one yesterday, Clay, that 5 different fees. I'm like, that is, I mean, usually I see 3, but 5? I was like, holy moly. And it was a mutual company that was selling, that somebody had sold the UL product on. And I could not believe the amount of lines of fees and charges. And some of those fees, like administration fees and those things, are not coming in a whole life product. They're not changing. They're not there because we don't have money in the market. And so the universal, the chassis, I'm going to say, you probably can't say it, but I'm going to say the cost of insurance is the same. This argument I've had with people forever. Oh, cost of insurance in a universal life is less than cost of insurance in whole life. No, you're going to die at the same time. It doesn't matter what product they're selling you. The cost of insurance is the same on your life, but how that chassis works is different.
Well, the two chassis definitely work differently, and it would be wrong to assume that there's no mortality charges or premium loads that are built into a whole life policy.
Right, correct.
Because they're there, they're just not picked apart. You can't see them. You can't tell at what level an actuary, when they price a product, is assuming those charges will be down the road. The big difference, I think, and this is what I would focus on if I were a client, is with all of its flexibility, universal life really allows the client to determine the long-term configuration of the policy. So think about it. With a universal life policy, one thing that's definitely different between UL and whole life is that universal life premiums can be set by the policy. So let's say you bought $100,000 whole life policy, all base coverage, and let's say the premium was $15,000. That really can never change. You might be able to offset that premium by partially surrendering paid up additions in a particular year, or maybe finding the money someplace else or whatever. But somebody, somehow, some way, that $15,000 has to be paid every year on the base
policy will lapse.
So let's say I had a $100,000 whole life policy, universal life policy. Now, again, I'm generalizing here. All policies are a little different, but generally, universal life allows the policyholder to kind of change that premium level if they wish. And so let's say you started out at $15,000 for a $100,000 policy. If down the road you wanted to lower that to $5,000, you could in most situations. and now you're getting billed for $5,000. You're paying the full bill every year. And I think sometimes now that policy is probably what I would call underfunded. It's probably now, if nothing changes, because we're paying a lot less premium, it may be on a path where it might not, it might lapse at some point down the road. But I'm not sure all clients fully understand that when they change their premium, if they increase it or decrease it. The bottom line here is the onus. The onus on keeping that policy in force is somewhat transferred from the insurance company to the client. So in whole life, we set the premium. You have to pay that. So the onus to keep that policy from lapsing is absolutely on a whole life company's, is on the whole life company. But with a universal life policy, if you can change the premium you want to pay for a particular amount of death benefit, then the onus is really more on you to make sure that that policy is on a path toward where it's not going to be underfunded or where it's not going to lapse in the future. Does that make sense?
Mm-hmm. Yeah, but we're even seeing policies that have been paid in full collapsing because cost of insurance isn't set in a universal life. Cost of insurance, they can raise the cost of insurance if they want. They can raise fees and charges, which then means we haven't paid enough money into the premium, or a premium's not set high enough because they didn't price the product correctly.
Well, generally when you see that, it's probably because there has not been sufficient premium been paid from day one.
So it's sold incorrect.
I've always felt if you were going to buy IUL or any UL, that you should pay the same premium that you would have to pay on a whole life side, right? You shouldn't. Occasionally I will see universal life policies where the premiums are lower per thousand than, a very similarly configured whole life policy. And, now what you would be doing then is you'd be counting on all of those current assumptions to stay there. And if for some reason those current assumptions were to not play out the way you expect, now that policy could be underfunded. And you would have been better suited to have paid the same premium as like a whole life type policy would have prescribed. Does that make sense?
Yep, because I've seen universal life illustrations that say to keep this policy going to maturity, X amount of premium needs to go in. And it is the exact same amount of premium needed to keep that whole life going. And so we're underfunding it from day one because we should have had the same premium. Because again, like I said, to make it very simple, cost of insurance is the same because you're that same person and you're going to likely die at that same time. Not universal life doesn't mean you're going to live longer than whole life. It is that it actuarially, cost of insurance is cost of insurance on somebody your age, your health, your family history, all that good stuff. So what is the difference? Can you just give us a short synopsis of what is the difference then with a variable UL?
Well, generally the UL chassis is the same. It would have the same issues and advantages that I mentioned earlier with being able to change things down the road. The big difference with VUL is in the return assumption. And with variable universal life, generally, your premiums are placed into, trying to think of the right word for that, essentially that your money is invested in the market, right? Is it actually invested directly in the market? Sub-account. So it'd be like a sub-account. Okay. You might have a sub-account that's primarily invested in bonds, or you might have a sub-account that's invested in equity securities, or you may have a sub-account that tries to emulate an index such as the S&P 500 index or something like that. But the point is the return is not coming from the company's general account. The return is coming from a company's separate account. And that separate account, the money is actually invested the way you as a policyholder have directed that company to invest it. And it's in the market. And so because it's in the market, it can do anything the market can do. For instance, of course, it can do quite well. The market can have phenomenal returns, but let's also recall that the market can have negative returns. So you can actually go backwards in a sub account because it's directly invested in the market.
Yeah, the variable UL that I saw yesterday, in a 3-month period of time, cash value went down by $2,000 or $3,000. But when you have a variable universal policy, you will also get within your statement or illustration or policy, it'll show you what accounts it's invested in. And so I don't think a lot of people understand that either. So, okay, so a universal is typically a guaranteed. They have some sort of a guarantee return, rate of return. In a variable, there's no guarantee. It's completely reliant on, tied to the market. And then in an indexed, how is that even more different? This is the most confusing.
Let's just make sure that we understand when you say guarantees. Like a variable universal life may very well have some guaranteed charges or guaranteed, mortality costs, things like that. It might.
I meant rate of return. Sorry,
doesn't have any guaranteed return. Right?
I meant rate of return. It's not going to have a guaranteed rate of return. Sorry.
And so index universal life is a fixed product. Your money is never actually invested in the market. Generally, the returns are provided by derivatives that the company would invest in to give you a portion of the return that mirrors some type of an index or in several indices. And again, these are generalizations. Many times you'll see where the way it works is that if the return in the index is less than zero, they just guarantee the return will be no less than zero in that particular for that particular year in your policy. But then usually the trade-off for that is that you may not be able to get all of the upside of the market, right? So if the market's way up, you may only get a portion of that. So it's, some they provide a little bit of upside protection. Downside protection, but then there's also usually an upside challenge there, or some type of it caps it at a certain level of return. The thing about any UL policy, especially IUL and fixed UL, is usually when you look at an illustration, there's usually a page on the illustration that shows the absolute guarantees, right? And it'll show the premium that you're projecting or wanting to pay, that you've chosen to pay. And then it'll show the absolute guaranteed cash value and guaranteed death benefit based on, the worst case scenario, the absolute guarantees in the contract, when that would be like the guaranteed worst return that we would guarantee that you would make that in the policy. And then like the guaranteed worst mortality charges that we could ever charge, and then the guaranteed worst expense loads that we could ever charge in the contract. Usually those are the kind of the three biggies. But in any event, that column will show you those guaranteed cash values and guaranteed death benefit. If I were buying an IUL policy, I would want to set my premium at a level that those guarantees would never run out of money. In other words, that it would show the policy would always have values all the way to policy maturity. At the very least, all the way to whatever age I project that I think that I'm going to die, right? And so occasionally you'll see that guaranteed column, it will not show the policy staying in force all the way to age 121 or policy maturity. It'll show cash value going to zero at some point. And what that means that policy would lapse at that time, generally, unless there's some type of secondary guarantee layered on top of that. So if I were buying the policy, I think I would try to set my premium level at a high enough level where there would at least always be guaranteed values through policy maturity. Does that make sense? Yep.
And in an IUL, your guarantees are going to be zero because that's all that they can guarantee. So I've never seen an IUL that the illustration, the guaranteed column is zero with the max charges. And that is something else that I'm going to point out. This is not coming from Clay's mouth. I'm going to point that out, that those charges, those cost of insurance charges and fees can be increased. And so we have had, and I have read articles of companies that have been sued years and years ago that they didn't price a universal life product correctly. So in order for this to save the companies behind, they increased fees and charges and put that back on the policyholder to pay that to keep their policy going because they maybe didn't have the money or something. But history has shown that these companies, I mean, I've never read an article that somebody's gotten sued for whole life because it failed. But there's lots of articles about people being sued or companies having issues with universal variable index type products and overpromising fees that are changing, those sort of things. And there's just a company made news the other day about the fact that they had to, and correct me if I'm wrong, you would probably say it better than I would, Clay, but the article showed that they didn't price their product correctly. They guaranteed the death benefit was going to stay. They guaranteed a death benefit. They guaranteed the premium to stay the same, but they didn't price the universal life product correctly. And so the company had to dip into reserves to make policyholders whole. That's scary when your company is not looking at those risks and accommodating for that.
You know, the one thing I would throw out is that I think all life products have their place, purpose, and you know, some. I don't think you can make a blanket statement that one particular product is always better than another product. It really boils down to a client's personal, you know, desires, needs. The thing I would really throw out to clients is just do the best you can to fully understand the product that you are buying, because you're going to have that product for a long time. Usually people buy permanent life insurance policies for a permanent period of time, right? For their whole life. And so that's a long time. And so you know, if you're going to make a purchase for such a long time, do yourself a favor and really investigate how that product works and understand what it is that you're buying. Because many times when people are unhappy with something that they've purchased, you know, like an insurance type contract, sometimes it usually boils down to a misunderstanding about what maybe the expectation of what they thought they were getting versus what they really did get. And so I would just really encourage people to understand all of the things that are going on in a contract before you make a purchase.
Yeah, I would agree with they need to understand, but I would not agree with you, Clay, that there's a universal life chat policy that people should buy. Maybe if they're going to overfund it forever, but because the fees and the charges are not locked in, and I have seen so many bad ones, I want guarantees. If I wanted to play, this is what I always tell my clients, if you want to go play the stock market, just go get a 401k or IRA, but don't do it with your life insurance. And so I am not going to agree with you. I love you, Clay, but I'm not going to agree with you on that statement. Because I think whole life is the best. And it, again, just the guarantees, but it is super vital. I hope that you guys understand looking at companies, making sure that they're conservative, making sure you have the right product. This game, and that's not even a game, this process of infinite banking is not just about buying a policy. It is about understanding what you're buying and who you're doing it with. And so many people just want to go buy a whole life insurance policy or buy a life insurance policy without doing their due diligence. And you just can't do that because there's so, as Nelson would say, there's so much noise that you're going to have to put a little bit of effort in. I mean, what I just saw yesterday was absolutely insane. I mean, we've got $1.1 million of death benefit that I can't replace it for this guy at 67 years old. I cannot replace that for what he's paying for premium. But his policy, his variable universal policy, they're going to be gone. He's got 2 policies. They're going to most likely be gone before he passes. And one of them has a death benefit rider that we're guaranteeing death benefit forever. But it was very ironic. I've never seen this before, that the owner of the policy said, well, it's paid up. The insurance agent said that it's paid up. I don't have to pay on it anymore. Cash value is going to collapse, but the premium outlay on the illustration still showed premium being paid. Well, where is the premium being paid from if the client's not paying it? So the insured's not paying it, but there's premium outlay and there's a guaranteed death benefit rider, but nobody's paying premium and there's no cash value to do that anymore. So there's just, I mean, I went back to the client and said, this is a serious question. Why is it showing that? And how is this getting paid? Insurance companies don't just pay people's premiums just to pay people's premiums. And so there's so many different structures of policies. There's so many policies. There's so many companies. Be aware of what you're buying and do it with a good company that has history. And if you're working with a mutual company, if you're listening to this and you have a policy with a mutual company and it's not whole life, why? Why were you sold anything but whole life if you're working with a mutual company? It does not make sense to me. I know One America has sold universal. They have a variable product. I won't sell it. It's never going to be on my books. One of my clients will never get it because I don't want the risk. I don't want to have to go to my families later and say, yeah, we use this for estate planning, but it wasn't there. That's not the business I'm in. So with that, Clay, thank you very much for being here and putting your head on the chopping block.
My horse's head.
I appreciate it. It wasn't too bad. It wasn't too bad.
Oh, absolutely. It's a pleasure to be with you. And thank you so much, Mary Jo.
Yeah, you're welcome. Okay, you guys, you know the drill. If you have questions, comments, concerns, Mary Jo at Without the Bank. If you need those books for Christmas, let me grab them. The whole bundle. $10 off with the audios. Get them for your loved ones because they need them. Okay, you guys, you have a fantastic week and we'll see you in the next podcast.